The last way of valuing a property is the income approach. So as you can imagine, if a property has an income, it's probably being used as a business of some sort. And that's exactly the case. The income approach is going to be used mostly on commercial properties. A very common application of the income approach is to evaluate multifamily properties, apartment buildings. When using the income approach, you start with what's called the gross potential rent, or the GPR. That means if you had every unit or every square foot of that property rented out for the going market rate, how much money would that property bring in? Say that's $100,000. Well, if people aren't occupying the property, you're not making money. So you subtract the vacancy, say that's 10%. Now we're down to $90,000. Next, you're gonna subtract any other losses. Say for example, people who never paid their rent and maybe you had to evict them. So say maybe you lost another $5,000. Now you're down to $85,000. Next, you're going to subtract the operating expenses. Well, what are the operating expenses? Those are things like repairs and maintenance, taxes, insurance, administrative expenses, all of the money that it costs to run that property. It does not include your mortgage payment, your interest, or your principal. That's what we call below the line. We look at that, but we don't look at that as part of valuing the property. After you take out your expenses, so say in this case your expenses were $50,000, well, 85 minus 50, now I have $35,000. $35,000 is called the net operating income, or the NOI. The NOI of a property is the first piece you need to figure out what it's worth. The second thing you need to figure out what a commercial property is worth for the income approach is called the capitalization rate, or the cap rate. A cap rate is a rough approximation of what that investment is going to return over time. Okay, let's break that down a little bit. Right now, Aceable is in Austin, Texas. Here in Austin, Texas, in the downtown area, the going cap rate for a high-rise apartment building is going to be something close to 4%, maybe 3.75%. That means that if you buy that building, you can expect a 4% return on your money, roughly. So how's a cap rate used for finding the value of a property when you're using the income-based approach? Well, the cap rate is going to be determined based on the market. So this is kind of tough. You have to get to know the market or the sub-market that you're operating in. You have to talk to people, you have to get out there, you have to read things. But if you do that, you're gonna have a good understanding of what the cap rates in certain cities and certain areas of those cities are going to be generally. Now, this is not something that's published or established by some sort of government entity or anything like that. A cap rate is simply a measure of the market. So when you have your cap rate and when you have your NOI, you can figure out the value of that property. Say you have your cap rate, you figured it out, you've done your research, you know that the cap rate in this neighborhood is 10%. And you know that the NOI in your property is $35,000. This is annual. It's always calculated annually. Well, what do you do with that? You take $35,000 and you divide it by the cap rate. So it is NOI divided by cap rate. Now pay attention to your division when you do this, because you are dividing a percent. And remember, a percent is a ratio. It translates to a decimal. So in this case, we have 35,000 divided by 10%, which is 0.1. So 35,000 divided by 0.1 is 350,000. So that property with an NOI of 35,000 and a cap rate of 10% would be worth $350,000. The income approach is going to be the way that most commercial properties are valued. This is going to be what you see when you deal with apartments or office space or industrial real estate. This type of approach is not going to be used so much if you're dealing with residential real estate. So depending on what sector of the industry you want to operate in, it may or may not be something you want to make sure that you get familiar with.